Hello, everyone. On today's episode, we're going to discuss the language of business with Brian Quartuccio. Now, really at its core, we're going to take a look at financial statements, but don't turn the dial. There's 4 reasons the information in this episode is critical to your upskilling success and quickly laid out for you. If you are working for a corporation and you want to break through to management, this is a skill that matters. It sets you apart to the nth degree. If you're an entrepreneur, this skill matters. If you care about your personal balance sheets, this skill matters. And if you're interested in flipping businesses, this skill matters. Welcome to the Ultimate Crowdsourced Personal Finance Show. This is Choose FI.
You're listening to Choose FI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. Choose FI, your home for financial independence online.
All right, guys, very excited to dive into this week's episode. And to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I am doing quite well. Yeah, this should be fun. Obviously, it's always great to have Brian on the show, and I get to flex my little geek CPA knowledge from decades ago. So this is cool.
I'm nodding because it'll be a solid flex, man. Solid flex.
No, it should be good. And like you said, I think if somebody reads, oh, we're talking about financial statements for an hour, they might turn the dial. But this is truly critical information for every single person listening. Very simply, as you laid out, another one would be if you're just in the market for buying individual stocks, like Brian has talked about so many times, knowing these financial statements is really, really critical. And as Warren Buffett has said, so actually there's this book, Warren Buffett and the Interpretation of Financial Statements, which was referred to me by none other than Brian Quartuccio. And Mr. Buffett's quote is, you have to understand accounting and you have to understand the nuances of accounting. It's the language of business. And it's an imperfect language, but unless you are willing to put in the effort to learn accounting, how to read and interpret financial statements, you really shouldn't select stocks yourself. And that's just such a cool quote. So, Brian, thank you for the recommendation, and thanks for coming back on Choose FI. We're happy to have you here.
Thanks for having me, and I also look forward to nerding out on financial statements with you, Red.
Sounds like a plan.
So, Brian, financial statements, the language of business. When did this get on your radar? And it seems like over the years, you're placing increasing levels of importance on it. Let's talk about the first version of that where you stumbled into the skill set.
Yeah, I've been interested in investing essentially since I discovered it in 2004. And I personally am just someone that dives into topics and just reads and reads and reads about them. And I eventually discovered the stock market, eventually discovered individual stocks. And I wholeheartedly agree with what Warren Buffett said. Essentially, if you don't know how to read financial statements and if you don't take the time to learn them, you have no business picking individual stocks yourself. So I just 100% agree with them. I could tell you a quick story about how financial statements actually helped me beyond just learning to pick stocks. The company that I was previously working for went from private to public markets. And this was a company that I had personal stock in, just like everybody else in the company. Every quarter, my company reported earnings as is required. And every quarter, I would dig through the financial statements, read through the transcripts, and take notes for myself. Well, one day on a whim, I decided to share my notes with the members of my small little team. And we were at the very, very bottom of the organization. And I copied my manager on them. Well, my manager was so impressed with the notes that I took that she forwarded along to everybody at her level and copied her manager on that. And it just went up and up and up the chain at the company. So much so that the next time we were at an all company retreat, the CEO was on stage talking about the emails that I sent out every quarter for how to interpret financial statements. And he was asked about, what are we doing next earnings? And they said, well, just wait till Brian Quartuccio emails you and breaks it down for you. So this was literally a case when every single person at my company was getting an email that I was taking, just that I wrote for myself on a whim. And I became a go-to source for so many of my colleagues whenever something happened that they wanted me to break it down. So I think that is a very real use case where me showing that I knew how to read financial statements really helped me to stand out in my organization.
Brian, that's incredible. And right, as you said, you were at the lowest level of the company, but just having that skill made a name for yourself, right? And this was before, obviously, many, many years before you had, 300,000 Twitter followers and, you're well known as a Motley Fool contributor. This was just Brian Feroldi, lowest level of the company. And now the CEO knows you by name. So, I mean, that's just a cool kind of life and business hack. We always talk about these things like, how do you make a name for yourself? How do you become invaluable in a company? Well, maybe understanding financial statements when approximately 0% of other people in the company know how to read them. That's pretty cool.
Yeah. I would say outside of people that work in accounting, the number of people that I've met in my career that actually know how to read and interpret financial statements is a very, very low number. And by the way, I include in there senior management, people that went up through the ranks because of marketing or because of HR or because of sales. A lot of those people are extremely skilled in their area of business knowledge, but it's not uncommon for them to essentially become financially illiterate when it comes to reading financial statements.
You used two terms there. You said read financial statements, and then, in parallel to that, or in addition to that, you said interpret. And so, when I think of the word read in this context, I'm thinking, where to find them, the documents that would be relevant. But interpret is a whole nother layer about what does that mean to you? Like when you were sending out these, notes periodically, how did you turn that data into information or into something that is usable for other people when they digest it?
Sure. So financial statements are most useful when you have many of them linked together and you can really see the story of a business. I mean, you have to use your emotional brain when you're thinking about business as well as your analytical brain. And financial statements very much give you the actual numbers of a business. And you can use financial statements to determine, is the business growing? Is the business dying? Are there any challenges that are arising up? How much cash does this company have on hand? If it's not making money, how long can it live before it has to raise capital again? That last question is very pertinent right now because we've seen valuations of so many companies absolutely collapse in the public markets. And if it's a company that is burning capital and living off of its balance sheet, well, all of a sudden, raising fresh capital is no longer an attractive option given what's happened to stock prices. So yeah, learning how to read financial statements is one thing. Learning how to interpret them is also equally important.
Yeah, I love that you brought that up because I actually made a note before we hit play here and said, over a long enough timeline, a company must be profitable. And I was actually thinking about precisely that. These companies that have been so hell-bent on growth for so long and, they've been able to raise capital and raise billions and billions of dollars. You think of the Ubers of the world, right? And over a long enough timeline, if you do not have net income, it's hard to imagine you being able to continually being able to raise capital from new investors who are looking at a company that has maybe no possibility of ever making net income. So I'd be curious to hear your feedback actually on that statement, because I don't think that's like 100% verifiable fact, but in my opinion, it's pretty darn close, but I'd love to hear what you think.
I would say that companies can actually lose money for a far longer period of time than you would assume. For example, Amazon didn't quote unquote make money on a net income basis until about 2016. So it was that almost 20 years of not making money. But as Brad, as you know, because you can read financial statements, there's different definitions of what making money actually means. And there can be enormous differences between net income, adjusted net income, and free cash flow. So even the definition of what does profitable mean is something that has nuance to it.
Yeah, brilliant response. So, all right, let's get into it. So, Brian, there are 3 major financial statements. Why don't you first start with just a super quick overview? Because like you said, these play into each other, right? So give us a very high level overview, and then we'll dive into each of them.
So there are 3 financial statements that are the most important for investors to know or anybody to know. There's actually more than 3 financial statements, but there's 3 main ones. They are called the balance sheet, the income statement, and the cash flow statement. And to your point, all 3 of them show a company's financials, but from different perspectives. And these 3 financial statements work together, and they're all interrelated to each other to give investors a more complete view of the financial picture of a company. So let's start with the balance sheet. This is simply a sheet that shows what a company owns and what it owes. It is very similar to your personal net worth statement. So if you ask somebody, what is your current net worth? They would say, well, here's what I owe. I would subtract what I owe. The difference would be my net worth. That's a balance sheet. So a balance sheet shows what a company owns, which is called its assets, what it owes, which is called its liabilities, and its net worth, which on the balance sheet is called shareholder equity. But that's what a balance sheet is. There's also an income statement, which is kind of like similar to your personal budget. It shows how much income is coming in, how much revenue or sales a company is making, and then it's showing line items for each of the company's expenses. And then the bottom of that number shows a company's net income, which is one definition of, am I making money? Is it positive? Am I profitable? Or am I losing money? Is it negative? And then the sister statement to the income statement is called the cash flow statement. And these two statements work very much in tandem with each other. And the cash flow statement is very similar to like your checking account. I think the best way to describe a cash flow statement would be to say to somebody, what's the difference between your salary, the top number on your paycheck, and what actually hits your bank account, the bottom number? Everybody knows that those two numbers are very different from each other, right? If you make $100,000 per year, how much actually hits your bank account? Is it $60,000 or $65,000? So that to me is the difference between the income statement and the cash flow statement. The income statement is kind of like what you would give to your accountant and to show your tax bill on. Your cash flow statement would be actual changes in the cash value of your bank account. So there's the balance sheet, the income statement, and the cash flow statement, and all these things show a company's financial statements in slightly different views.
Yeah, that's a great explanation, Brian. And certainly, as you said, there's a direct analog between looking at this in terms of an investor or a business owner and our own personal financial statements, right? And this is what we talked about so many times here on Choosify. We've talked very specifically about the balance sheet, right? Which is just, as you said, your net worth statement. It's what do I own minus what do I owe? You get your net worth. Very, very simple. And what's interesting, and I know you have a presentation, which we'll link to, but a balance sheet is, and this is critical, it's a point in time. So it's a snapshot on one given day. It's not based on a period. It's just, okay, on December 31st, 2022, this is my net worth at this exact instant. So that's really important to remember about the balance sheet. And then the income statement is a period of time. So it can be whatever period you choose, right? Some people might do it monthly. I think most people are going to do it yearly. And again, the analog between a company's income statement and how we look at it from FI might be, hey, this is what my savings rate is for this year. So as you said, it's, are you profitable or not? It's a budget. It's like akin to your regular budget. So in our case, in personal finance, it's, all right, I have all of my income that's coming in, less all my expenses that are coming out. And I get to that bottom line of, hey, what's my savings? And that's the analog to net income for a business. So it's interesting how this really does tie together. And I just want to make clear that this is not just for investors. This is not just for business owners. This is for every single person listening to this. So I think what's interesting, the cash flow statement, Brian, I'll be curious to dive into that because I think that's, of the three, that's the least known. And it's also the least understood why it's so important. And I think it is critically important, but it's kind of like the forgotten of the three. All right, Brian. So why don't we start? We've got to pick one. So let's start with the balance sheet. I think that's the logical place to start.
Sure. So the balance sheet, I think the critical thing to know about the balance sheet, Brad, is like you just said, it is a point in time snapshot of a company's financial statement. This makes sense because if you were to check your own personal net worth, it literally changes minute by minute, right? Depending on what asset prices are doing in the stock market, real estate, value of your business, etc. So a company takes a snapshot at the very end of its quarter or year and presents that information to investors. So there's three key parts to the balance sheet. There's the assets, and that equals the company's liabilities plus its net worth. And net worth is just called shareholders' equity. This is very similar to the equation. Again, what's your net worth? You would take your assets, you would subtract your liabilities, and that would equal your net worth. The accountants decided for whatever reason to just reverse that and say assets equals liabilities plus shareholders' equity. Same exact equation, just putting the liabilities on one side versus the other. But in terms of asset, there are two broad categories. There are current assets, and those are things that the company expects to use or can access within 1 year. So that would be things like cash or marketable securities, accounts receivable or inventory. And it can include things like prepaid expenses. And that would be like if you prepay for your car insurance for a year, that would be an asset that you expect to use in the next year. And then there's also long-term assets, which are things that benefit a company for longer than a year. Some accounting terms are things like goodwill and fixed assets. But think of that personally like your house. Your house is an asset that you expect to use for longer than a year. So that's the important thing to know about assets is that there's two types. There's current, you expect to use it in less than a year, and long-term, which you expect to use in more than a year.
Yeah, that makes perfect sense. And the house is actually a really great example, right? So imagine that you had $1 million in cash, let's say. You're buying an expensive house. As you said, it's a current asset, right? Cash and cash equivalents. That's very clearly on the asset side of the balance sheet. And let's say you buy a house for $1 million in cash. So your assets stay the same. Correct? Nothing has changed on the balance sheet. You still have $1 million worth of assets, but now it is gone from cash and cash equivalents of current assets to a long-term asset of this house in that case. And another kind of little flavor would be, okay, forget my first example and just say, hey, I own a house worth $1 million. That's the market value of it, but I have a mortgage for $990,000. Clearly, your net worth is not $1 million in that case. It's not the asset value. It's the net of those. It's the million minus the 990,000 is $10,000 in that case, or the net worth, at least from this house in this example. So it's just important to kind of understand mentally how all this stuff fits together.
You got it. And speaking of $900,000 in mortgage, that's when we get to the other side of the equation and we can talk about liabilities. So liabilities are bills that a company owes and has to pay. And just like assets, there are two main types. There are current liabilities. Those are things that need to be paid within this year. So those can be things like accounts payables. So if you owe your employees money, if you owe your suppliers money, if you owe interest on any debt that you have, and any debt that you have that's coming due within the next year, that would be a short-term liability. There's also long-term liabilities, which would be debt that you have that's due in longer than a year, or that could include things like pension obligations for a company. And like Brad just said, very similar to think about that like a mortgage. You're not going to be paying back your mortgage this year, unless, of course, you're going after FI and you reached your milestone there. But that would be, a mortgage would be classified as long-term debt, whereas if you had credit card debt, for example, that would be classified as short-term debt. And then finally is probably the most confusing term of the three, which is just called shareholders' equity. And broadly speaking, this is the amount of the total net worth that the investors in that company have and how it's accounted for. Now, there are some very wonky accounting-like terms on this, such as terms like common stock. That's the term that investors are most familiar with. If you're buying shares on a public exchange and like Apple or Microsoft, that would be you're buying common stock. And then there's other terms like retained earnings, which is the cumulative value of all profits the business has earned, treasury stock, which is stock spent on buybacks, preferred stock, etc. But broadly speaking, the shareholders' equity shows the total net worth of a company that is owned by the investors in that business.
Yeah, that's great. And I could actually give an interesting little example, I think, that would explain that retained earnings. So let's again go back to regular life. Okay. And the critical piece here is why this is on this balance sheet is assets, as you said, equals liabilities plus equity. It has to balance. That's the critical part about a balance sheet. It has to equal, right? So let's say hypothetically, somebody was starting with $0 of net worth, zero liabilities, nothing. They have absolutely no financial assets or anything right now. So they have zero, right? And then in a year, let's say they earn $100,000 and they spend 80. So they have $20,000 left over in that case, right? So their net income, we would call it savings in normal life, but their net income was 20,000. So what does their financial statement, what does their actual financial life look like right now? They have $20,000 of cash, right? Because that's the amount left over. So that's the asset. And then the other side of the balance sheet needs to equal, right? So it's liabilities plus owner's equity. Well, they have no liabilities in this example. And their equity, their net income, their built in over the years, and we're saying it's just this 1 year, was $20,000 of net income, right? So it balances. It's the $20,000 of assets, the $20,000 of equity. So that is just the really simple, like, accountant's way of looking at this and saying, oh, this actually does make sense. It looks wonky when you first look at it, but there's logic to it. And that's how, Brian, these things tie together. So that's clearly coming directly off of the income statement.
Yeah, and Jonathan asked before about the interpretation of balance sheets and stuff. Balance sheets, again, are a snapshot. They're a point-in-time picture. They become most helpful when you look at balance sheets sequentially. So if you look at a company's balance sheet year after year after year, you can answer questions like, is their cash balance growing? Are their assets growing? Are their liabilities growing? Are they losing money? Are they giving back money to shareholders? All those things can be said if you have multiple balance sheets in a row.
Well, let's take a look at that through the lens of that first anecdote, the story you shared from back in the day. And I'm just thinking, these can highlight, because the thing is, they're a metric of truth about the health of your business or the business that you work for. It could highlight the growth and the incredible positivity of the company that you're working for. It could also be the, guys, you might want to start thinking about buffing up your resume because, so I would imagine if your CEO is reading your notes, it's because it was more of the former. He was pleased that the data confirmed the general emotions that he wanted his employees to feel. And I'm just curious, like, one, maybe you could say whether that's true or not, but then two, what was conveyed to the organization when they could actually interpret these notes that you were building off of this data?
Well, the company at the time that I was working for was actually losing money. And it was one of those companies that lost money for almost 18 years in a row, and yet has been wildly successful. And last I looked, was worth over $10 billion. So when I was reporting these numbers, the company was actually reporting net losses, and yet its stock was, broadly speaking, going up. Now, that confused the heck out of me when I first started. Like, how can we be a quote unquote successful business if all we do is lose money? But that's when the story and the growth rate and the income statement in particular was what really saved the day.
Hey, this is Andrew from the Choose FI team. Hope you're enjoying the show. We're going to get right back to it after these quick messages.
So Brian, if someone were to, really grab hold of what we just talked about, let's say they're working inside of a large, corporation, what could they do with, real comprehension and understanding of the different financial statements that you just discussed?
Well, we've talked about the balance sheet so far. And again, a balance sheet is a point-in-time snapshot of what a company owns and what it owes. And this kind of information can be critical, especially right now if you are working for, let's say, a high-tech startup that's running on venture capital. Many of these companies have gone public and they're still losing money. That was part of the plan all along. Well, one thing you can do is look at the company's balance sheet and you can figure out how much cash does my company have? Does it have any debt? How much potential runway could this business have ahead of it? We've seen layoffs amongst tech companies right now. I think the sad truth is we're probably going to see some more, and raising capital for a lot of these businesses is going to be very, very challenging over the next year and potentially longer. So if you just want to do a quick health check on your company, go to the balance sheet, see how much cash they have, see how much debt they have, and ask yourself if those numbers look healthy to you or they could potentially be cause for concern.
And specifically, you mentioned something there, and I think the word that came to my mind is runway. A company that is out of cash and can't raise capital will make drastic cuts in order to hold on to the life rope. A company that is losing money but has cash or has the ability to get more capital can potentially outlast whatever season that we are particularly in. Is that a good framework for how someone would evaluate the intersection of these two statements?
Well, yeah. So next we're going to talk about the income statement. So the balance sheet is it's just a fact, right? How much cash do they have at any given time? How much debt do they have at any given time? To figure out the runway, you need to incorporate the next statement we're going to talk about, which is the income statement. Again, so the income statement is a measure of a company's revenue or its sales, and then subtracting out all of its expenses over time and leaving with the bottom line. Is there a profit or is there a loss? So for example, let's say a company had $100 million in cash, and you also notice that on the income statement, it was losing $10 million per year. Well, quick math shows that this company could continue to do so conceivably for 10 more years without having to worry about its financial future. On the flip side, if a company has $100 million in cash and it's losing $100 million per year, well, that's going to be really big cause for concern because that company is going to need an injection of cash in the next 6 to 9 months. And that might not be something that is possible right now. So that company would likely have to go into drastic cost-cutting mode in order to just survive. But let's flip over to the income statement. As Brad mentioned, the income statement is measured over a period of time. So the most common periods are a quarter, so 90 days, or annually, which would be a full year. So that's important to know about the income statement. The top line of the income statement is a company's sales, which is a company's revenue, the total value of all the products and services that were sold during that period. And then from there, we start subtracting costs and expenses to figure out, did we make a profit or not? So the very first cost that we subtract is what's called cost of goods sold. And those are all of the expenses that were made into actually making the product or service. So let's say we're Starbucks and we sell coffee. We sell coffee for $10 just to make the math easy. How much did we spend on the cup? How much did we spend on the water? How much did we spend on the coffee? How much did we spend on the employee's time that made the coffee? What are all the direct costs in making that cup of coffee that was sold? So let's just pretend they were $5 and we sell it for $10. It costs us $5 to make it. That would give us our next number, which is called gross profit, which is the amount of profit that we made from selling the product or services. Unfortunately, we're not done subtracting expenses from there. There's a whole bunch more we have to think about. From there, we subtract operating expenses. So these would be sales and marketing costs, research and development costs, management costs, land costs, building costs, insurance costs, basically every cost that we have in the business that's not related to making the product or service. From there, after we subtract that, we get an operating income. And this is a measure of, is the business making money from just running itself, or is the business losing money? However, we're still not done subtracting expenses because we have to subtract non-operating expenses. So this could be things like interest expense. If a company borrowed money, they have to pay interest. That's not an operating expense, but it is a real expense. So from there, we subtract all non-operating expenses and we get what's called pre-tax income. And again, from there, we have to subtract income taxes. So after finally subtracting that last expense, income tax expense, we're left with the bottom line, which is literally the bottom line of the income statement, and that is called net income. And if this figure is positive, it means we are quote unquote profitable. And if it's negative, it means that we are losing money. But that's a broad overview of the income statement over a period of time.
All right, Brian. So, we're after tax, we have that net income, right? This is the profit or loss for the business. But it certainly doesn't end there, right? Now we're talking about, okay, if you're an investor, right? If we're looking at that from one of our 4 or 5 different options of how financial statements can help you, if you're an investor, there's more here. And I know you've talked in the past about the number of shares, the earnings per share, things like that. Like, is that where we go? Is that the next logical step from, okay, I've got this one hopefully large number of profit. What do I do with that?
Yeah. So the next step from there, after we have a net income or a net loss, is to divide it out by the total number of investors in the business. And the way that we track that is just by using the number of shares that are outstanding. Every business, every publicly traded business is split up into shares. That's how we determine how much of a corporation each company owns. So for example, Apple has 16.32 billion shares outstanding. So let's say that Apple in 1 year made exactly $16.32 billion. Well, that means that $16.32 billion divided by 16.32 billion shares means that each share has a claim on $1 of that profit. And that gets us the final number, which is the earnings on a per share basis. And this is actually a really critical number for investors to know, especially in publicly traded business, because it's one thing to see a company made $1 billion or $10 billion or $5 million or whatever the number is. It's another question to say, well, how much of that do I have a claim on if I'm becoming a shareholder?
Brian, so earnings per share, that makes sense. But is that number in a vacuum useful, or is it dependent on the cost of the share? Like, talk us through, okay, there has to be something else, right? It's not just a magic number.
Oh, very much so. So we're just talking about the earnings per share. And it doesn't mean if Apple earned like $1 per share, it doesn't mean that $1 is going into your bank account automatically. That's a whole nother equation. This is very much theoretical, right? This company earned X dollars in per share. How much of their profit do I have a claim on if I become a shareholder? Brad, what you're asking about is the relationship between the claim on the earnings per share and the value of the company on a per share basis. And that gets into the price to earnings ratio and the relationship between the company's stock price and the earnings that it earned on a per share basis. That's a separate discussion, but you are absolutely right that this figure, earnings per share, ties in directly to the company's share price.
Nice. And yeah, we've talked about price to earnings ratio on a prior appearance of yours. I think hopefully we can call that up, or we'll put it in the show notes, certainly. But you keep saying a claim on the earnings. So what does that mean to the layperson, a claim on earnings?
Well, this is why stocks have value in the first place, right? It makes no difference if Apple makes $90 billion if I don't have some sort of legal claim on that amount. And that's what you are buying when you buy a stock in a business. You, in a very, very real way, have a legal claim on a portion of that company's profits and assets forever. However, what the company does with those profits is entirely up to the discretion of the company. Some companies choose to take a portion of that profits and literally give it. They give it to the shareholders in the form of cash. We call that paying a dividend. Other companies choose to take that money and reinvest it back into the business. Perhaps they buy back stock with it. Perhaps they make acquisitions with it. Perhaps they just let it pile up on the balance sheet and see their cash balance go up and up and up. So what the company does with the profits that it makes is different than what the investor receives, but this is, in a very real way, how much of a claim on those profits each individual investor has.
Yeah, that makes a lot of sense. So right, there are a bunch of different options that the people running the business can do. And we as shareholders have put them in charge, right? We put the board in charge ultimately. And these people are the ones who decide what happens with those earnings. And like you said, you can give a dividend, you can invest in your current business, you can buy new businesses. The one that I want to dial in on, because I think it ties into what we were just talking about, is the repurchase of shares. So you were talking in this case of Apple in this hypothetical, they made 16.32 billion and there were 16.32 billion shares. But mechanically, what happens in a share buyback and how does that impact earnings per share?
Sure. So let's continue using Apple as an example. And we were pretending Apple made $16.32 billion. There are currently 16.32 billion shares outstanding. So each share has a claim on $1 in earnings per share. But Apple has been buying back, repurchasing its stock from its investors. So it's using a portion of its profits to go out to the open market, buy shares that investors have, bring them back into itself, and then essentially deleting those shares. So let's fast forward the clock and pretend that Apple bought back 1.63 billion shares of its stock, so 10% of all its shares that are outstanding, and that it made the exact same amount of money the next year. Under that case, we would actually see that the earnings that each investor got that has a claim on would actually go up by 10%, even though the total value of the profit didn't change. That's because we're now splitting those profits amongst fewer investors. So this is why companies buy back their stock. It reduces the number of claims that there are on the profits of a business. So even if the profits of a business don't move, each individual investor's claim on those profits go up simply because there are less shares outstanding.
Right. And it's really important to think of yourself as you are an owner of this business. Sure, you might own 1/16.32 billionth of the business per share, but you are an owner nonetheless. And when you as a company, which is what's happening, your company is deciding to erase, as you said, some of those little ownership shares, well, you own a larger percentage. It's still small in this case, but it is a larger percentage. So therefore, you have a larger claim to the earnings. So it's really, and this is why I wanted to dial in on this, is you need to think of yourself as a business owner when you are a shareholder, because that is what you are. You are a tiny little business owner, but you are a business owner nonetheless. And as Brian has said, so specifically, you have a claim on those earnings. And when there are fewer shares that are outstanding, you have a higher claim.
All right, so Brian, we've talked about the balance sheet and we've talked about the income statement. Let's talk about the third statement or the third category, the third financial statement that we'd be interested in.
So the third financial statement is called the cash flow statement. And this is a fun fact. For many, many years, companies were not required by law to report the cash flow statement. They only had to report an income statement and a balance sheet. But there can be a massive difference between what a company says that it makes in profits on the income statement and what actually changes in its bank account. And one company that really took advantage of this fact was called Enron. And Enron actually did not produce a cash flow statement with its earnings. And that is one way that it was able to deceive investors for so long. So actually, in the wake of Enron going under and that whole debacle, the laws changed and companies were suddenly required to release cash flow statement with all of their earnings. So thanks, Enron, because now we get to look at the cash flow statement.
One funny thing about that, as I'm thinking about it, although Enron got caught and imploded in spectacular fashion, I bet you they weren't the only ones doing it. Just a very extreme example. Can you imagine like when all these companies suddenly had to produce these new documents, how quickly and aggressively they were having conversations with their accountants? Could we make this look a little less bad? Because that'd be great.
Well, Jonathan, you're joking about that, but you can imagine these financial statements can dramatically impact what happens to a company's stock at any given time. And you can imagine the pressure that executives have on them to make these financial statements look as good as possible. And Brad knows as well as anybody, there are a number of tricks that accountants can use to make these financial statements look and massage the way that they want. And one reason why it's so important to also look at the cash flow statement in addition to the net income statement is that the income statement is kind of like an opinion on whether we were profitable or not, but a cash flow statement is like a fact about where we're profitable or not.
Yeah, I love that. Everything washes out in the cash flow statement. That's kind of how I think about it. And it is the least known of the three. And it's interesting, Brian, I actually did not realize that it wasn't a required public statement before or when Enron was going under. And the kind of historical note is when I graduated college, I went to work for Arthur Andersen, which was the biggest and most well-known accounting firm in the world. And 9 months later, because of the Enron scandal, that firm blinked out of existence. So I have a very personal history with Enron. And it's funny because that helped me ultimately think of and find FI. So one step led to hundreds of other steps, and I guess led me here in an interesting way. So anyway, bizarre little footnote, but nonetheless. So, all right, Brian, cash flow statement. Where does it start? How do we look at this thing? Where do we even go from here?
Yeah, so the cash flow statement ties in directly to the income statement. And while the income statement, again, shows an accountant's opinion of were we profitable or were we not profitable, there is a whole bunch of factors that can cause that profitability or not question to skew up or down very, very easily. But the cash flow statement kind of hammers those back out and forces the company to show, well, what actually happened to your checking account during the period. So the cash flow statement, actually the very first line of the cash flow statement is the net income. So it starts with the bottom line of the income statement, and then it goes down line by line and makes adjustment for, was this thing a source of cash? Did it make our cash balance go up? Or was it a drag on cash? Did it make our cash balance go down? So one quick example there would be something called accounts payable. So this is amount monthly that you owe to your employees and to your suppliers. Well, on the income statement, you're accounting for these expenses as you go. So you can say, yes, we owe our employees X amount of money. Let's just say it's $1 million. Or we owe our suppliers $1 million. That's probably a better example. Well, whether or not you actually paid them that $1 million that you owe them is an entirely different fact. So on the income statement, you would have to deduct, yes, we owe our suppliers $1 million for this period. And the cash flow statement shows you, well, did you actually pay your suppliers or not? Some businesses, you're allowed to have a credit with them. So you may not have to pay them for 30 days, 60 days, 90 days, or even more. So the cash flow statement will actually show, did we pay our suppliers that $1 million? If we didn't, that means that we have an extra $1 million on our balance sheet because we haven't paid it out yet. If we did, then it would account for that fact. And there's some other wonky accounting terms, such as depreciation, such as amortization, such as accounts receivable, which is the exact opposite. Did the people that we sold products to, did they pay us or did they still owe us money? And all those factors get added back in or subtracted on the cash flow statement to show, did the company actually produce cash during the period or did it consume cash?
All right, Brian. So that all makes sense, but it can get a little bit confusing, especially in terms of, as you said, like depreciation and some of these non-cash items. But at some point, cash went out the door. So there's a way that it ties together here with the income statement and the cash flow statement that I think is really, really critical that we dial in on. And I'd love for you to give an example. So in this presentation that you created, you talk about buying a new car that has a 10-year life. And I'd love if you could walk us through that, because I think this will make this very clear.
Yeah, it's a hard thing to visualize, but I think everyone understands how the accounting works of buying a new car. So let's say you're in the FI world and you go out and you buy a brand new car. This car costs you $33,000 and you don't finance it. You would pay it for cash right up front. You expect to use this car for 10 years. And at the end of 10 years, you expect to sell it for $3,000 and pocket that. So let's talk about what you actually experience from a cash flow perspective. On day one, you buy this car, $33,000 leaves your bank account, right? You own this car for 10 years. And while there are costs about maintenance and gas and all that kind of stuff, it actually doesn't cost you any money to just own the car, right? You already paid for it on day one. And conversely, in year 10, you are done with the usefulness of this car, you sell it, and you get $3,000. So your bank account goes up $3,000 from selling the car. That's what you actually experience on the cash flow statement. However, the nuances of accounting make it so that lumpiness of what we just experienced isn't useful to accountants to determine, is this person profitable or not? So what the income statement does is it smooths out those costs over the life of owning the car. So the net cost to you over this 10-year period is $30,000. You paid $33,000 for it. You get $3,000 at the end. You're spending $30,000 over a 10-year period. However, to smooth out that cost, accounting uses a term called depreciation. And on the income statement, rather than saying we have a negative $33,000 hit in year one, we go to the income statement and we say we only have a $3,000 hit in year one, and in year two, and in year three, and in year four, all the way through to year 10. So the income statement shows a depreciation charge to account for how we are using the car and what it costs us annually. The cash flow statement shows us how much cash is actually leaving our account on any given year. And this is why showing the exact same thing, right? Buying a car, owning it for 10 years, and selling a car has such different accounting when you're looking at the income statement or the cash flow statement.
Yeah, this is really interesting. And it actually ties into the third statement also, right? The balance sheet. Because basically what would happen is when you bought this car at the beginning, you would buy it for $33,000, right? So let's say you bought that, as we're saying, in cash. You would have had $33,000 in cash. Now you have a $33,000 asset, right? This car asset. But every subsequent year, as you said, okay, there's this depreciation that goes on the income statement as an expense, but it also goes on the balance sheet as accumulated depreciation. So it actually nets from the value of your car. So your car doesn't stay on the balance sheet as worth $33,000 the entire time. It's the net of these two. So it actually gets reduced, because then at the end of our 10 years, when this is fully depreciated, then when you go to sell it, the gain or loss is based on what that net number is. So that's what's really interesting. These all tie together. And I think it's really important. The most important thing, I think, here is the income statement aspect, right? Because anything that's capitalized, anything that ultimately goes onto your balance sheet, an asset that is depreciated, you don't get that full deduction for it in that first year. Okay, this is the critical piece that everyone listening needs to understand. So you buy a $100,000 piece of machinery that is going to last for 10 years. You don't get to deduct as an expense off of your income statement and ultimately what you pay tax on. You don't get to deduct that full $100,000 in year one. Okay, it's just the depreciation expense. So if we're saying it's a straight line depreciation over 10 years, it would be 10 grand a year. That is what is netted against your income for determining the ultimate profit and net income perspective. So it's fascinating, Brian, how they really do all tie together.
And you can imagine how there can be a big difference between the income statement and the cash flow statement when you're talking about terms like depreciation. And that's one of the more simple terms to understand. It can get far more complicated from there. But that's why if you're going to be buying individual stocks, if you're going to be starting your own business, accounting might sound dry and boring, but I think it's actually a really critical skill for people to learn.
One of the things that always comes to mind, I love this idea of the talent stack and upskilling, and I think this falls very neatly into it, but I like for people to be able to see a use case in different scenarios. And we've talked about a couple, but the one that I keep coming back to, and I think there's such significant room here for people in our community, is one, being able to value a business for the purposes maybe of considering whether to purchase it. So you could just be an entrepreneur and start your own, or you could purchase an existing business. Or three, because a lot of people have kind of side hustled or moved into real estate, et cetera, to become a business broker. Look, if you understand this skill and you know how to properly and accurately, value a business, and you can combine that either one with the inclination to buy it, or two with the ability to matchmake to people to find buyers, that is an incredibly profitable and not a lot of competition for that space relative to what you see in other areas. And I have a neighbor that actually is a business broker. He happens to be an accountant, and he talent stacked his way into this, and he crushes it. He helps dentists that are leaving their practice find a buyer for their practice. He knows about, laundromats who are looking for a reseller, HVAC companies, and he matchmakes. And really the core competency was the background of being an accountant, and then being able to take that talent and upskill it and focus it on financial statements and how that would apply to small business owners. It just seems like an incredible opportunity. And so I thought maybe we could take those we talked about the 3 financial statements, and we could focus that just a little bit on the idea of valuation and determining, is a company being competitively valued? What would be a fair offer for a company in a particular industry?
Yeah, so valuation is one of the most tricky questions that there is when it comes to investing, figuring out what is a business worth. One of the most simple and straightforward ways that we've talked about valuing a business before is using the price to earnings ratio, the PE ratio, and we actually did a whole show on that. But broadly speaking, if you're looking to buy a business, what you're actually looking to buy is a company's future, current and future profit stream. So if a company, let's just say a very simple like HVAC company or something like that, produces a profit on the income statement of $1 million per year, it would be reasonable for you to look at that number, add a multiple to it, and then take that and say, this is what I'm willing to pay for your business. So let's say you were willing to pay 10 times a company's profits to acquire that business. Well, if it was 10 times $1 million, you should be willing to pay $10 million to acquire that HVAC business. And where does that $1 million in profit come from? By looking at the income statement. Now, that is the simplest way to do it, and there is way, way more information that needs to go into figuring out what a business is worth. But when companies are valuing businesses, they are absolutely looking at the 3 financial statements that we talked about, running scenarios to figure out what is a business worth.
Well, that's an interesting point that you brought up, because you talked about that multiplier. And one thing that I've become aware of over the last 5 years is that multiplier is different depending on the industry. So like, for instance, in kind of websites and tech, you hear a lot of like that multiplier 4 to 5 or 5 to 10, something like that. Whereas in more manual labor, large inventory type businesses, it's a lower multiplier of like maybe 2 to 3 or 2 to 4, somewhere in that range. Do you have any sense, just as I said that, for why that multiplier changes so much in different industries?
Very, very much so. There are numerous factors that go into that. One simple way to think about that is not all businesses are created equally. Let's say I have a business that sells candy or something like that. Candy is something that people buy in bad times and in good times. It doesn't matter what's going on in the economy. People are willing to spend a little bit of money to buy Hershey's chocolate, right? So what's happening in the economy doesn't really impact Hershey's profitability or not. So I would be willing to pay a higher multiple to acquire Hershey's profit, because I can be confident that if a recession came, I'm still going to make money. Conversely, if you take a very cyclical company, such as a home builder, well, in boom times, when the housing market is on fire and everyone wants to own a housing and credit is free flowing, housing companies can rake in profits, have absolutely enormous amounts of profit. But if I was an investor, I wouldn't value that profit very much because I know once the cycle turns, that company could be going from making $100 million to break even or potentially losing money. One real life example that we've seen this happen with is a company called Coinbase. Coinbase recently came public. And when they came public, the crypto market was booming and they were making billions upon billions of dollars because interest in their company was so high. More recently, in the most recent quarter, Coinbase's profits absolutely collapsed simply because the entire crypto market is down and the demand for trading crypto is so much lower. Many people have looked at Coinbase's price to earnings ratio and said, it's only single digits. That makes no sense. This is a leader. This is growing. The reason it's like that is because investors are saying, we don't think your profits are sustainable because they're so dependent on this outside factor, crypto prices, to go up or down. And if you compare that to like Microsoft has a PE ratio that's in the 20s or even low 30s because their earnings are so predictable and don't really depend on the business cycle. So that is one factor that can really go into, is this an industry that is predictable profits and we should pay a higher multiple for, or will profits evaporate if something happens and we should pay a much lower multiple for?
All right, this is a lot of fun, Brian. I mean, it was really cool to put this in perspective, the language of business. And I realized, like, a lot of this is one of those things that you listen to the conversation and hopefully you grab those nuggets, but it's going to require, if you really want to go farther, you're going to need some visuals. You're going to need to see the represented information. So Brian was kind enough to share with us the presentation. And, if you're listening to this live, make sure you are on the newsletter, the 5-weekly newsletter. You can go to choosify.com/subscribe. Brad is going to be sending you guys out a copy tomorrow. And you'll also be able to go back to the archives if you're listening to this after the fact and find that presentation to check out. You can find that again at choosify.com/subscribe. Brian, if people want to nerd out farther, man, if they want to go into more depth on any of these topics, what's the best way to connect with you and your content these days?
The easiest way to find me is on Twitter. I'm at Brian Feroldi. And if you are interested in financial statements, I've actually done deep dives into all 3 of the financial statements, as well as how they relate together on my YouTube channel. Hopefully, Brad can send those out too if people really want to dig into the details.
All right, friend. Thanks for joining us on the show today.
Thanks for having us.
All right, my friends, the fire is spreading. We'll see you next time as we continue to go down the road less traveled.